you, 'cause you feel my mind, or you feel my mind. We could build a dream, start up something new, and the world is on your shoulders, and you feel like falling over. Just let me in your head, so I can be there for you, there for you. The night is young, won't you sing for me? Won't you sing for me? Feel we fall asleep. The night is young, won't you sing for me?
Hello, everybody. Welcome to VC Masters, only on the Pod TV network. I'm Nick Pallavita. I'll be one of your moderators for today. And today we're obviously going to be discussing venture capital and venture capital investments, including what the latest news on that. So with that, we're going to be bringing the star of the show, a person who has been doing venture work for many, many years, none other than Dr. Salman Azar. Dr. Azar, welcome to the VC Masters. And, I was curious about one thing because when it comes to investing, having experience makes a difference. How long have you been doing venture capital investing, and when did you get started doing this?
Well, I have been doing this since 2001, which makes it 25 years. I have been doing it right for 19 years. The first 6 years, I was really not doing it right. And that's pretty much true almost of anything, is that you take some time to learn. In fact, after 6 years, I almost quit. In fact, I did quit. And one of my mentors basically educated me. He said, it's not that something is wrong with you or something is wrong with VC. It is just that you are not doing it right. And he kind of showed me the ropes. And since 2007, I've been doing it professionally. And really kind of investigating the companies, really making smart business decisions, and following the smart money, and working with smart people to learn more and more about what's going on. And the other part of it is the network. You grow that network over that period of time. You don't get some of your best deals initially.
Mm-hmm. Yeah, and when it comes to networking, how do you go about meeting people in the industry? In other words, the venture capital community is a tightly knit group. How do you go about meeting people in this particular industry?
It's very hard to break into this group because there are two issues. One issue is that, are you adding value? And the second is, are you adding money? So if you really think about from a professional network perspective, if you're an executive and you're trying to grow your career, all that you need to prove is that you are adding value, because they'll give you the money. In VC industry, you need to have both money and value that you add, which is hard to prove. And that's one of the reasons it's kind of like by invitation only. You just, if you think about it, it's, use a basketball analogy, you hang around the hoop and, once in a while, a rebound will come to you. Once you get enough rebounds, then people will notice you that you can rebound. So you have to kind of, and VC is also like this, right? You invest in a company and you wait like years before you get that money back. So it is a very much of an investment in career in terms of proving value.
And what city did you start in when you decided you were going to get involved in this? Did you start in North Carolina, or what city did you start in?
It's very hard to start in North Carolina, and I have a lot of respect for those who did start in North Carolina or still in North Carolina. I started in the Silicon Valley during the peak, or actually just after the dot-com bubble burst, 2001. And the reason I started is that the valuations were much cheaper at that time, and I could get good deals. I was an entrepreneur before that, raising money because the valuations were high, and it was really an arbitrage for me to kind of go over to the other side. And that's really where the action is, and it is really easy to hang around the hoop. Here in North Carolina, you raise like a few $1 million or tens of millions of dollars, and you're a big time VC. And no offense intended. I mean, like it is hard. It's just hard. I mean, even raising like $10 million is hard over here.
Mm-hmm. Yeah. So you actually started your career in the San Francisco area, the Bay Area?
Yeah, San Francisco Bay Area. I was basically San Jose and the Peninsula. At that time, the center of gravity was really between San Jose and Palo Alto. It has moved further up north to San Francisco as well. And it is kind of spread, if you think about Bay Area, it's kind of like a U-shaped thing. And the center of gravity was kind of like in this part, and now it's kind of like spread a little bit more around that on that U. But when I was there, it was pretty much Silicon Valley, which is San Jose and neighboring areas. And it's really a great place. I mean, if you're really want to be a VC, you should start by being an entrepreneur. And if you want to be an entrepreneur, you should start by working in somebody else's startup, because you will learn the ropes there, go through the entrepreneurship, and then go into the VC career. There is this policy that I am going to go and get educated and from Harvard, and I'm going to then become a VC. The best VCs are former entrepreneurs that are not people with MBAs and PhDs and so on.
And when you're doing this, how many companies, since you've been doing this for 25 years, how many companies have you invested in over the last 25 years?
So I have over 300 companies now. I have acquired, just last year, I went on a buying spree last year and acquired probably around 50 or so. And some of them were part of basket. Some of them were kind of individual investments. I'm particularly working these days in secondary investments. And the thing about secondary investments is that we buy shares from existing investors who need cash at a discount. So we are not investing directly in the companies. We are actually buying shares of existing investors. And there are lots of advantages to doing that these days.
And how do you keep track of all these companies? Do you have a computer spreadsheet, or what do you do to keep track of them?
This is embarrassing. It is really ultimately it's really a spreadsheet that summarizes everything. I have a folder for each one of these companies which has the details and stuff, but sadly it's a spreadsheet that keeps track of how much I invested, when I invested, and then I can do like pivot tables and all that stuff in terms of deal sources and so on. But it's a very simple spreadsheet that kind of summarizes it. Whenever I have an investment that needs to be increased in value or decreased in value, I would mark it in the spreadsheet. And the supporting documents, I have like a folder for each company, which has all the investor agreements, any reports, investor reports that's sent. By the way, the great thing, about investing companies is that it's very educational as well. So I have access to what like 300 companies are doing. To be kind of frank, like 100 of them don't give me any useful information. And another 100 basically are educational purposes only. In other words, they don't give me much in terms of financial information. But the 100 or so that give me financial and technical and operational experience, it's like, well, it's not, I would have said that it's like having a free MBA, but it's actually a very expensive MBA because I've invested a lot of money in these. But it is just sitting at the top of this and seeing about 100 companies in depth and another 100 companies in terms of generally where they're going is very educational. And that actually helps me become a better investor. And it also increases my deal flow in terms of looking for winners in my portfolio and betting more.
And when you invest in a company, how do you determine the management? In other words, whether the management is a group of good managers or bad managers? In other words, how do you decide on these particular companies? Do you meet with the owners of the company and you make a decision whether or not they're worthy to invest in? Or do you just rely on the profit and loss statements that they send you?
I'll give you the honest answer. I get criticized for this, that I'm not being inclusive enough, but I only invest in people that I know directly or I know through somebody who I know directly. So, for example, I would not invest if I get a random email from somebody. I don't even have time to respond to that. But if I know somebody, I will respond to that. Or if Nick, you, for example, introduce me to somebody, I will follow up with them. So I am only investing in people that people who I know personally, or I know somebody personally who knows them personally. And that basically, creates a little bit of a bubble. If some random email comes to me and the idea looks interesting, I would ask them to get introduced through someone. But generally, they won't even get a response.
Mhm. And how does the internet change your business? Because 25 years ago, the internet was just starting. As a matter of fact, there were a lot of .com businesses out there. But in terms of the VC industry, have you seen this change your business over the last 25 years, the access in the internet?
Yeah, definitely. So first of all, it has made investing a lot cheaper compared to what it used to be. I think in 2007 or so, we started seeing, Amazon Web Services and so on come into the picture as well. Before that, people used to buy their own servers and so on and so forth. And now you can rent servers. So it just makes things a little bit more efficient from a cost as well as a technical perspective. And then, the last 20 years have really helped in terms of how efficiently, how quickly we can develop things and take them to market. And almost any company these days needs technology in order to scale. As a VC, I'm looking for companies that are, going to be at least worth $1 billion, or we call them unicorns. Because when we are taking risks, at least, especially at the early stage, I don't do that early stage risk anymore, but for people taking that risk at the early stage, they need to look for companies that are going to give them that $1 billion valuation at some time. And internet and technology in general helps them scale. You can't really scale like, a taxi service, but you can scale Uber, for example. And, Uber is kind of an example of internet and network effect and mobile computing and all that stuff.
Mhm. Yeah. And are you looking to see artificial intelligence change your business at all or your business model on a going forward basis?
Definitely. So, what used to take me several analysts to do, now I can do with AI very quickly. In fact, I am working on a course these days, or actually courses with the CFO Leadership Council through Duke. And what we are seeing is that companies that have not embraced AI are being left behind. And the companies that have embraced AI foolishly are getting wiped out because it is not, it's like AI is like a weapon. And if you don't use that weapon properly, you can just shoot yourself in the foot. And a lot of companies are doing that. And there are a lot of crippled people out there shooting themselves in the foot, right? Which doesn't make sense. So there's a lot of education to be done here. But with that education, it's like, I am about 3 times as productive now as I was a few years ago. If you are just starting off a career, you can be like 10 times as productive because you can learn things. When I went to college, we didn't even have Google. If you wanted to learn something, we used to read manuals and we have to read these books and stuff. And, Encyclopedia Britannica used to take up a whole bookshelf, the bookshelf like, what you have there, because that was your source of information. Now that information is at your fingertips and it's not just searching, you can have a conversation and you can develop a better understanding. But here's the thing that you have to be careful of, that internet or AI without guardrails is very dangerous because it can be wrong. So anything that has to be verifiable 100%, you can't really use internet. And anything that you use internet for, you need to kind of be careful of what is the price of going wrong.
And what sectors do you look at? We had a panel discussion earlier, and we found Foot Locker was merging with Dick's Sporting Good. Interesting, the panel unanimously does not like retail, and that's a retail investment. Now, I'm not that prejudiced against retail because I'm going, well, Cheesecake Factory gets a lot of people, Costco gets a lot of people, but at the same time, retail can be very competitive. Do you have a particular sector you like and a particular sector that you stay away from?
Yes. So I have a Costco story for you. I'll wait on that though. So I want the companies I invest in need to be growing fast. At a later stage, I'm still looking for 30 to 50% growth. So for that kind of growth, technology is essential. Costco or any retail, as solid as it is not growing. So if I am entering here and the company is doing great, I am paying the price for it. If it is growing 10%, that's the gain that I have. If it is growing 30%, that is much better than growing 10%. And retail in general doesn't grow that quickly. And that's the reason why in Shark Tank, well, for that reason, I'm out. But if you're looking for income, you're kind of like near retirement and stuff, and you're okay with that 10% growth, and you like the dividend and stuff, then retail is good.
Mhm. And what about real estate as a sector? Are you hot on real estate or are you cold on real estate? What is your thoughts about real estate as a sector?
I actually made, my initial investments were all real estate, and the strategy I had is that any home that I bought, I didn't sell, I rented it out and used the rent to accumulate equity. And that worked fairly well as passive investment. But once again, the growth is not there. The only way to actually get an outsized return in retail is to acquire something that is distressed or undeveloped and then develop on it and then sell it. And that is really, it takes a long time, and it's a very capital intensive investment. So for that reason, I'm out. But again, if you're just looking for income like 8% or something like that, or on your investment, real estate is great. It really depends on what your investment objectives are. I want to double my money every 3 years or so. And real estate doesn't give that. And in order for me to kind of look for doubling the money every 3 years, I need at least like 30%, 25% return. Otherwise, I'm not going to be able to make that. And until I'm kind of like functional, I can find those kinds of investments that can give me those kinds of returns. Very thankful for being able to do that. But, there would be a time where, I would be 80 years old, hopefully. And at that time, I don't want to kind of like work as hard looking for these investments, monitoring these investments, looking at all the investor reports and stuff. It's like waking up every day and like reading, or responding all day long.
Yeah, and now I have to ask you a question that goes around our circuit because we do have a couple financial shows. One is cryptocurrency and Bitcoin. Some analysts say, well, you should put a certain amount of funds into cryptocurrency and Bitcoin, but then we have some analysts say, why would you do that? What is your thoughts on cryptocurrency and Bitcoin?
I'm one of those that would say, why would you do that? The value of cryptocurrency is derived from the value that people place in that. It is very similar to gold, except gold has a real use also. So there is some intrinsic value, but there's no intrinsic value. The moment people switch from one currency to another currency, it hurts. And the sad thing is that people have over leveraged. So they know the MicroStrategy was a company I respected a lot because I used their products earlier. This was back in around 2000 or so. I used their products, and they made great products. And they just decided that they're going to make all their investments into Bitcoin. And they had and they leveraged, over leveraged. And then when Bitcoin went down, they struggled. And it's just not a productive asset. So if you really want to kind of like invest in currency, invest in gold. I mean, gold in still, but it's not just me. Warren Buffett also says gold is not a productive asset. So I'm using that lens. It's not a productive asset. Blockchain as a technology is good for many things. And that's basically where the key lies, to use blockchain as a technology for other things. So for example, I've invested in a company called Chia that is using blockchain to separate the stock appreciation from the dividends. And now basically what you can do with that is you can invest in Microsoft stock only, which is great for hedge funds. and you can invest at, let's say, 80% or 90% of its value. So you leverage your gain. The other side of that is that you can invest just in the dividend. So if you're a pension fund and Microsoft is yielding, let's say, 0.7%, and you get Microsoft at 1/10 of the price, you basically have a 7% yield. Now, what you sacrifice is that if Microsoft stock goes up, you don't gain from that. But if it goes down, you don't lose either. And you just get this guaranteed, 6-7% yield of a stable company. So that's a great use of blockchain. And that's where investment in blockchain makes sense. Buying cryptocurrency is just like, you might as well buy euros. And if you think euros are going to do better, you may do well. I don't know. You may do not. It can go in either direction, and there's no intrinsic thing that makes it grow.
Yeah. What about, since we're discussing euros, and I was actually discussing the euros with the dollar in the exchange earlier this morning, what is your thoughts on international investing? In other words, companies that are outside the United States?
With everything going on in the world right now, I do not know what my thoughts are. But as a matter of general principle, international investing is a good idea because it diversifies you. It is just that we are living in very uncertain times. And I guess, we've been saying that for the last 5 years, ever since COVID started, that we are living in uncertain times. But we're really living in uncertain times. Probably, the world wars were the more uncertain time than that. But with so much international conflict going on, there were a lot of travel that I had planned. I have put on hold and so on. So I don't know where that is going. So international investing is good. We as a firm are only investing in US. And part of the reason is that when we invest in a company, we help it go public or get acquired as quickly as possible. And we can only do that in US because my partner has filed dozens of S1s and taken companies public. So we add value there. So it is all about where you're adding value. And we add value to companies that are going to go public in US, even if they are international companies. But international investing is great for diversification. I just am not kind of looking in that direction until we kind of have a little bit of stability in the world.
And how do you compete against the big players like BlackRock, Vanguard, and things of that nature in terms of, or are they even in the venture capital market?
So they're trying to enter the venture capital market, and competing with them is really easy. I mean, they are playing in a different space. And I learned this from Peter Lynch, who was the initial, I think he was the founder of the Fidelity Magellan Fund, which was one of the, rocked the mutual fund industry. And he said that, he left Magellan because it had grown too large. And he said, now whenever I have to make a bet, it moves the market. So when I want to sell something, it depresses the price. If I want to buy something, it actually turns it into a bidding war among other people. So we don't compete with them because we are really kind of more like scrappy VCs. We are looking at what can we do with a few $1 million. A lot of investments at that level turn out to be bidding wars, and you have the companies that you acquire generally get overpriced. So we, I like to say that we actually fish for deals below the surface, and when we do that, we can generally buy them off market. So you can think of it almost like if you buy something, buy a home that multiple people are bidding on, you're going to overpay for that home. Whereas if you buy a home that in Durham, North Carolina, for example, where there are not many people bidding, so we bought the home that we live in. We bought over a weekend. And just took a home equity line on our San Jose home and just paid for it in cash, and we got a great deal. I mean, it is not a mansion. I don't need a mansion. I'm happy to kind of live in a comfortable place, but compare that to the homes in Bay Area when we were there is that we had to bid for those. So those people have to bid for those. They're a much, they don't get the same value, and it takes a lot for them to generate that return. One other thing, I am a hungry VC. I make my money on the carry. And carry is basically, I get a percentage of what the investors make. And if investors don't make any money, I really don't make any money. Whereas these big firms make their money on management fees. In fact, I was talking to a PE person trying to do a collaboration, and he said, well, you know, we don't really care about how good your investments are. We care about how big your investments are. And that is disincentive to make money for you. So they make money on raising funds. We make money on investing funds. And that is the reason I don't have a guaranteed $1 million paycheck like some of the fund managers do, or even like multi-million-dollar paychecks. I am completely dependent on how good my investments do and how much return they generate.
Yeah, you talked about valuation, and you're working with closely held companies generally. How do you go about valuing the company? What sort of process do you use to assert that this is what we'll pay per share?
Yeah, so these days the valuations have become much more easier for us because we are investing in late stage companies. So there is a method known as CCA, comparable company analysis. So what we do is we look for companies that are comparable to the company we are investing in, and typically look for how much, if they recently raised funds in the open market, what valuation did they get. And if they're a public company, then obviously we have their records and stuff that we can get information. We have like a lot of information that we can get on other companies that are comparable that person on the street cannot get through our network. So it is much easier to value companies at the level we are investing in. The earlier stage, it is more like spray and pray. Really, you are trying to kind of like see if this company has the legs enough to become $1 billion company, and you're just you're just gambling, sensible gambling. It's like playing poker. You basically look at your hand and you calculate probabilities and so on and so forth. But it is not as easy to do at the early stage.
Mm-hmm.
I did promise you.
Yeah, go on.
I did promise you a Costco story that tells you how cheap I am.
Story. Okay.
I once had an international investor that wanted to meet me in LA, and I met them in LA. I was all planned, with how the investments are doing and so on and so forth. And they said, where do you shop? And I said, I shop at Costco. And I said, so they thought I was joking. But seriously, where do you? I said, yeah, I shop at Costco because I can get, almost anything that I can get at Costco. If I need something that is not at Costco, then I will look for wherever I can get the best deal. And they were like, where? So I had to call my friends in LA, and they told me about Rodeo Drive or something like that, which I thought was Rodeo Drive. And, my friends were making fun of me that, you're calling it Rodeo Drive. But we just like, fund managers like us, VC firms like us, we get the best possible deal. We don't go to like, Bloomingdale's. I don't even know if Bloomingdale's is around, or Nordstrom or whatever, and, pay 10 times as much as I would get the same thing at Costco. So this shirt is Costco. This tie actually Duke gave, and they serve their purpose.
Mm-hmm. And Costco also is an international company because there are Costcos in Spain as well as around the United States. And I think they had a very interesting business plan to pay dividends basically on membership fees. But how we pay dividends at VC Masters is giving people the tools and opportunity to get in a sector that is not very well known, which is actually the venture capital sector. Do want to thank Dr. Salman Azhar, who heads up the Azimuth Opportunity Funds, and also our viewers in the United States and around the world. And we'll see you next time on VC Masters on the Pod TV network. Take care. Bye-bye.
I go anywhere with you, 'cause you fill my mind, or you fill my mind. We could build a dream, start up something new, and the world is on your shoulders, and you feel like falling over. Just let me in your head so I can be there for you, there for you.